negative in 2025. Financial highlights. While everyone is focused on rates and liquidity, there's been a substantial increase in asset values. Rising steel and labor costs, as well as new building orders from other segments, has filled available yard capacity, driving prices higher and delivery dates later. Since January 2021, 5-year-old LR2s have increased $12.5 million per vessel. If we apply this increase to Scorpio Tankers' 42 LR2 vessels, it would increase gross asset value alone of the LR2 fleet by $525 million. It also means your LTV is decreasing. In January, we announced the sale of 14 vessels. These sales increase our liquidity, reduce our debt, and crystallize the steep discount our shares trade relative to our net asset value. After the completion of the sales, the company will have over $460 million in pro forma liquidity. As Emmanuel mentioned, to maintain liquidity with rates below all-in cash break-even levels, we have refinanced vessels as opposed to raising equity, and also sold some. If we look at the debt repayment schedule, which excludes amortization for the 14 vessels that will be sold, the company has 2 maturities in the next 8 quarters. The convertible bond, which will be repaid in Q2, and a credit facility that matures in Q4 2022. In the past, we've seen different comments and figures around the debt that's due in a given period for the company. So for clarity, if we use the credit facility that's due in Q4 as an example, which is the blue box in the repayment graph, before this facility matures, we arrange to refinance the vessel in the facility with a new lender. Thus, when the facility matures in Q4, we repay the $16.9 million debt balance and then draw down on a new loan facility. Alternatively, we could sell the vessel, repay the debt, and collect the proceeds. This happens to be an LR2, so at current prices would generate significant liquidity. If you look at the company's balance sheet over the last 6 quarters, you wouldn't see a significant change. However, our view of the balance sheet is that after several challenging quarters, LTVs have decreased. We have $600 million in pro forma liquidity, which creates flexibility in the event of a longer market recovery. We have refinanced essentially all of our upcoming maturities and have minimal capex. We will repay $485 million of debt in the first half of this year from scheduled amortization, debt associated with vessel sales, and the convertible bond maturity. Given these points and our positive outlook for the market, we feel well positioned. To wrap it up, the company has the largest product tanker fleet in the world, comprised entirely of eco vessels. We have significant operating leverage. $1,000 a day change in product tanker rates equates to $42.7 million in annual cash flow. And we know rates don't usually move by $1,000 a day. We have positioned the balance sheet to provide flexibility with increased liquidity and a plan to delever. Our shares trade at a steep discount to our net asset value. The market inflection point is close, and the long-term supply-demand fundamentals suggest we could have an extended tanker cycle not far after. With that, I will turn it over to Q&A.
If you'd like to ask a question at this time, please press the star, then the number 1 key on your touch-tone telephone. To withdraw your question, press the pound key. Please stand by while we compile the Q&A roster. Our first question comes from Omar Nokta with Clarksons Securities.
Thank you. Hey guys, good morning, good afternoon. James, thanks for that. I think a pretty good run through of things, for the past year and a half or so, and you managed really to continuously enhance your cash position with debt refinancing. Aside from sale leasebacks, actual sales have not been something you've done in the past or recent past. So just regarding the LR1 deal, we've gotten used to seeing when an owner sells ships in a tough earnings environment, especially an en-bloc fleet, in an all-cash deal, they usually come at a discounted sale price. But your LR1's got a pretty hefty premium, I'd say. Can you talk a little bit about how that transaction came about and what really compelled you to move forward with it?
Sure. Okay, I think the easiest thing to first understand is that, as James pointed out, prices have been moving up and moving up quite strongly. So, you've got quite a strong sale and purchase market to start with. So you may have had the vessel sold at a surprisingly high price to the market. And as this James is inferring that, we strongly believe even now that net asset values haven't been adjusted up high enough. And that doesn't just apply to us, that applies to other product tanker companies with modern fleets. Now, those vessels, those less than 10 years, 7, 8 years old. So the first thing is you had a market that was very strong. It came about through a very competitive basis. I mean, we'd indicated in a couple of quite large conference calls and in the press that we would be willing to sell vessels as part of the liquidity position, that it's a win-win for us because, first of all, it increases liquidity, but second, I mean, it's a very rational thing for a management to do. When you think your NAV is trading above 30, and your stock is trading, below 50% of net asset value, and you believe that the fundamentals are very strong, but you have an uncertain point to recovery, you first get the sort of the knockout of you don't have to worry about liquidity anymore. The second thing you get is an offensive position where, we've always said to the degree that, that we're earning, above our all-in break-even 17 a day, then we're going to start looking to buying stock back as an alternative. So in an offensive position, the strengthening and putting cash on that balance sheet and getting the situation where when that market turns, the next question that analysts, and I'm sure you yourself will ask us, is you've now probably got too much liquidity, what are you going to do with it, comes at a much earlier point in the cycle. And we've had previous experience of the benefits of that. So that's really how it came about.
Thanks, Robert. Good color there. And I guess, just on the context of, being offensive and having too much liquidity, clearly now your pro forma cash position is, well over $400 million, which I think is the highest in many years. The question obviously now is how do you feel now with that position ahead of a recovery, and do you foresee future sales to maybe take advantage of that NAV arbitrage?
Sure. I mean, at the moment, what we see, we especially, as Omicron seems to be, going away, even faster as some people hope, and we're getting some analysis that actual headline demand for products and crude is much higher than people thought. So we look at this in the glass half full way. It's actually pretty incredible that you've had, apart from the United States, really not much flying going on in the world. You've had some form of restrictions going on in the last 4 or 5 weeks, even in the freest COVID countries, and yet the demand for oil and its derivatives have been so very strong. And you've got, as James pointed out, multi-year levels of inventory turndown. So that really sets up a situation where you've got this very long-term great market, and it's just a question of when that's going to happen. I think to your second part, that we're really comfortable in the actual liquidity part. We would not sell further vessels because we have to for liquidity, but I think it still holds true that maybe we would sell some more vessels just simply again, because once you have an NAV over 30 into a rising market that you're able to establish over and over again with sales, there's nothing wrong in actually, let's say piling on the cash and the optionality, especially when with a company with the amount of vessels that we have it just doesn't affect our operating level at all. I mean, we're not married to any particular